Before Warren Buffett buys a single stock, he does something most investors completely ignore. He doesn't look at charts. He doesn't chase trends. He doesn't care what the market did yesterday. Instead, he asks a few simple but brutal questions, questions that quietly decide whether an investment will create wealth or destroy it. This video is not about stock tips. It's about how to think before buying stocks, the exact mental framework Warren Buffett uses to avoid mistakes and compound wealth over decades. If you change the way you think before you invest, your results will change forever. Think like an owner, not a trader. The first rule in Warren Buffett's mind is simple but powerful. If you wouldn't buy the whole business, don't buy the stock. Most people buy stocks like lottery tickets. Buffett buys stocks like private businesses. Before buying, he mentally removes the stock market completely. No price movement, no daily noise, no analyst opinions. He imagines one thing only. What if the stock market closed for the next 10 years? Would this business still make money? Would customers still need its product? Would it still have pricing power? Would it survive bad economic times? If the answer is unclear, he walks away, no matter how popular the stock is. Buffett believes stocks are not pieces of paper that move up and down. They are ownership shares in real companies, with employees, customers, competitors, and risks. That mindset alone eliminates 90% of bad investments. Understanding the business comes first. Buffett never invests in businesses he doesn't understand, even if they promise high returns. He calls this his circle of competence. If he cannot clearly explain how the company makes money, who its customers are, why customers keep coming back, what could destroy the business, then the investment is rejected immediately. Complex businesses don't impress him. Simple, predictable businesses do. He would rather miss an opportunity than misunderstand one. That patience is not weakness, it is discipline. Ignore market noise completely. Buffett treats the stock market like a moody partner. Some days it offers high prices. Some days it offers low prices. Most investors react emotionally to this mood. Buffett does the opposite. He uses market fluctuations only to his advantage, never as guidance. If the business is strong and the price drops, he becomes interested. If the price rises without improvement in the business, he becomes cautious. Price follows value, not the other way around. This is where most investors fail. They think price movement means intelligence. Buffett knows it usually means emotion. Why this thinking protects you? Thinking like Buffett before buying stocks does three critical things. It protects you from hype. It protects you from panic. It protects you from yourself. Instead of asking, will this stock go up? You start asking, is this a great business at a sensible price? That single shift in thinking separates gamblers from investors. How Warren Buffett judges quality before price. Warren Buffett believes one brutal truth that most investors learn too late. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Before he even looks at valuation, charts, or numbers, Buffett asks a deeper question. Is this a truly high-quality business? Because price can change, trends can fade, but business quality determines long-term survival. The concept of economic moat. At the center of Buffett's thinking is the idea of an economic moat. A moat is not marketing. It's not popularity. It's protection. Buffett asks, why can't competitors easily destroy this business? What keeps customers from leaving? What stops a cheaper alternative from winning? If a company has no moat, profits invite competition. Competition destroys margins. Margins destroy long-term returns. Buffett looks for businesses where competition hits a wall. Types of moats Buffett respects. 1. Brand power. Some companies don't compete on price, they compete on trust. Customers don't ask, is this the cheapest? They ask, is this the brand I trust? This kind of loyalty allows companies to raise prices without losing customers. That pricing power is gold. Buffett understands that strong brands live in the customer's mind, not in financial statements. 2. Switching costs. Buffett loves businesses that are painful to leave. If switching costs time, money, risk, or confusion, customers stay, even if prices rise. These businesses grow quietly, steadily, and predictably. No drama, no hype, just consistent cash flow. 3. Network effects. Some businesses become stronger as more people use them. The value grows naturally with scale. Once established, these companies become nearly impossible to replace. Buffett sees these as self-defending systems. Competition weakens while the business strengthens. Management quality matters more than genius. Buffett doesn't look for flashy CEOs. He looks for honesty, rational decision-making, long-term thinking, respect for shareholders. He wants managers who treat shareholder money as their own. A great business with poor management will eventually destroy value. A good manager in a strong business can compound wealth for decades. Consistency over growth. One of Buffett's most misunderstood principles is this. He prefers predictable growth over fast growth. He is not impressed by explosive numbers that depend on perfect conditions. He wants businesses that perform well. In good times, in bad times, in uncertainty. Stability creates compounding. Volatility destroys it. Why Buffett waits so long before buying? Buffett often waits years before buying a stock he loves. Why? Because quality alone is not enough. Price must make sense. He is willing to do nothing, and that is one of his greatest advantages. Most investors feel pressure to act. Buffett feels pressure to be right. Patience is not inactivity, it is preparation, the real filter most investors ignore. Before moving forward, Buffett asks one final internal question. If I had to hold this business for the rest of my life, would I be comfortable? If the answer is no, he passes. No matter the upside, no matter the excitement, this mindset eliminates regret before it happens. How Warren Buffett thinks about risk, loss, and survival before investing. Warren Buffett's greatest advantage is not intelligence. It is not access to information. It is not even experience. It is his understanding of risk. Most investors think risk means volatility. Buffett strongly disagrees. For him, volatility is noise. Real risk is permanent loss of capital. This single idea changes everything. Rule no. 1. Never lose money. Rule no. 2. Never forget rule no. 1. These are not jokes. They are filters. Buffett does not enter an investment asking, how much can I make? He asks, how can I lose money here? If the downside is unclear, uncontrolled, or dependent on luck, he walks away. Risk is not the market, risk is the business. Buffett separates market behavior from business reality. A stock can drop 30% and still be safe. A stock can rise 200% and be extremely dangerous. He studies business durability, cash generation, debt structure, operational simplicity. If a business can survive bad decisions, bad economies, and bad luck, risk is reduced. If it cannot, no price is cheap enough. Debt is the silent killer. Buffett is extremely cautious about debt. Debt removes flexibility. Debt forces decisions. Debt turns small problems into disasters. He avoids businesses that rely on refinancing, depend on constant growth, collapse when interest rates rise. A strong business should not beg for survival. Buffett wants companies that can breathe freely even in crisis. Margin of safety. The core of Buffett's discipline. Buffett does not aim to be precise. He aims to be safe. He buys only when price is far below conservative value. This gap is called margin of safety. It protects against bad assumptions, unexpected events, human error. If valuation requires perfect execution, he refuses. If success depends on hope, he exits mentally before entering. Why Buffett avoids complex businesses. Complexity increases risk. If a business requires constant innovation, rapid consumer behavior shifts, regulatory dependence, unpredictable technology cycles, Buffett steps back, not because complexity is bad, but because understanding is incomplete. He invests only where outcomes are understandable. You cannot manage risk you cannot explain. Circle of competence. Knowing what to ignore. Buffett does not try to know everything. He tries to know his limits. His circle of competence is not fixed, but it is respected. If a business lies outside it, he does not analyze further. Ignoring opportunities is a strength, not a weakness. Most investors fail because they chase what they don't understand. Buffett wins by avoiding mistakes, not chasing brilliance. Time reduces risk for the right business. Time is dangerous for weak businesses. Time is powerful for strong ones. Buffett invests in businesses that grow earnings slowly, require minimal reinvestment, return capital consistently. Over time, compounding does the heavy lifting. He does not fight time. He partners with it. Emotional control is risk control. Buffett understands something most investors never master. Emotion creates risk. Fear forces selling. Greed forces buying. Impatience forces mistakes. Buffett structures his strategy so emotions have no control. He buys businesses, not stock symbols. He ignores daily prices. He welcomes market drops as opportunities, not threats. Calm thinking is a competitive advantage. Why Buffett is comfortable holding through crashes. When markets crash, Buffett asks, has the business changed, or has sentiment changed? If the business remains intact, price drops are irrelevant. This mindset allows him to act when others freeze. Risk is highest when people feel safest. Opportunity appears when fear dominates. The ultimate risk question Buffett asks. Before investing, Buffett silently asks, if markets shut down for 10 years, would this business still reward me? If the answer is yes, risk is acceptable. If the answer is no, opportunity is an illusion. This is why Buffett rarely panics. This is why he rarely trades. This is how Warren Buffett thinks about patience, timing, and when to act. If there is one quality that truly separates Warren Buffett from almost every investor in the world, it is not intelligence, capital, or access. It is patience. Buffett believes that investing is not about constant action. It is about waiting, sometimes for years, and acting only when conditions are overwhelmingly favorable. Most people are uncomfortable with waiting. Buffett is comfortable doing nothing. Why Buffett believes inactivity is a skill. Buffett has often said that the stock market is a device for transferring money from the impatient to the patient. He does not wake up asking, what should I buy today? He wakes up asking, is there anything today that is clearly better than doing nothing? Most days, the answer is no. Doing nothing protects capital. Doing nothing avoids mistakes. Doing nothing preserves emotional clarity. In Buffett's mind, inactivity is not laziness, it is discipline. Timing the market versus timing the decision. Buffett does not believe in timing the market. He believes in timing decisions. He waits for clear mispricing, understandable businesses, durable economics, strong management, wide margins of safety. When these align, timing becomes irrelevant. He does not try to predict recessions, interest rates, or headlines. He reacts only when opportunity becomes obvious. Why Buffett waits for fat pitches. Buffett compares investing to baseball, with one key difference. In investing, there are no called strikes. You can wait indefinitely. He looks for fat pitches, obvious opportunities with minimal downside and strong long-term upside. If the pitch is not perfect, he does not swing. Most investors swing at everything. Buffett swings rarely, and decisively. Cash is not trash, cash is power. Buffett loves holding cash, not because it earns returns, but because it gives flexibility. Cash allows him to act during crashes, buy when others cannot, avoid forced selling, stay emotionally neutral. He never feels pressure to be fully invested. Being ready is more important than being busy. Why Buffett invests for decades, not years. Buffett does not think in quarters. He does not think in years. He thinks in decades. He prefers businesses that compound quietly, grow earnings steadily, require little attention, reward patience. His ideal holding period is forever. Selling is a last resort, not a strategy. When Buffett finally decides to buy, Buffett buys only when he understands the business deeply. He trusts management. The price offers a margin of safety. The long-term outlook is stable. When these conditions are met, he acts with conviction. No hesitation, no partial commitment, no emotional bargaining. He commits fully, because the thinking was already done long before the purchase. Why Buffett ignores short-term news. News does not change business value. Buffett avoids daily headlines, analyst predictions, market commentary, emotional narratives. He believes that reacting to news creates noise, not returns. He focuses on what will matter in 10 to 20 years. Most news expires in days. Great businesses endure. The power of simplicity in Buffett's mindset. Buffett's investing philosophy is simple, but not easy. He believes fewer decisions lead to fewer mistakes. Clarity beats complexity. Consistency beats creativity. He does not reinvent strategy every year. He refines judgment over a lifetime. Why Buffett accepts missing opportunities. Buffett is comfortable missing opportunities. He does not chase trends. He does not regret missed gains. He believes that avoiding bad decisions matters more than catching every good one. Missing one opportunity does not hurt. Making one bad decision can destroy years of progress. Compounding. Buffett's quiet weapon. Buffett understands compounding better than most. Small advantages, applied consistently, over long periods, create extraordinary results. This requires patience, emotional control, discipline, time. There are no shortcuts. The final Buffett question before acting. Before investing, Buffett asks, is this decision rational, understandable, and sustainable? If the answer is yes, he proceeds calmly. If the answer is no, he walks away without regret. The Buffett mindset in one sentence. Buffett does not try to be smarter than others. He tries to be more disciplined, more patient, and less emotional than others. That is his edge. This is why Warren Buffett wins slowly and permanently. This is why his philosophy works across decades. And this is why thinking like Buffett is not about copying trades, but about adopting a mindset built for long-term survival and growth.